We are live. How you doing, friends? This is the third episode. Now, let me just explain. This is going to be a regular thing where I do this, what I'm going to be calling the Zero DTE Options Talk Show. And I'm going to turn this into a podcast. So everything that I say here will end up on the podcast. We'll do it 3 times every week, Monday, Wednesday, and Friday, unless there's a holiday. So if there's a holiday on Monday, then it will be on Tuesday, Wednesday, Friday. If there's a holiday on Friday, then it will be Monday, Wednesday, Thursday. And that coincides with exactly how the options work. The CME treats the options for the futures. They switch them up based on the holiday. But every Monday, Wednesday, and Friday, around 2 o'clock, I will be doing this show right here on YouTube and then repurposing or rebroadcasting on the podcast. So if you want to take it with you, you can, or you can watch it on YouTube when you're at home or at work. Great. And the topic will be primarily about the event, 0 days to expiration, 0 DTE, and how we trade it. So I have a service. I actually have 3 different services, the 0 DTE, then we have the 3D options, which, see, the 0 DTE is more like a day trade. The 3D options is more like a swing trade. And then we have the advisor, which is investing. And so we'll be talking about all 3 of those, but focused on the 0 DTE because it is so darn interesting. And the reason why it's interesting is that we have an incredible edge with the 0 DTE for 2 reasons. One that a lot of other people that are trading the 0 DTE also try to take advantage of, and that is that on the last day of options expiration, if you know anything about the decay or theta decay of options, the very last day is the time when premium decays off of the option the fastest until it gets down to nothing. So it is increasing exponentially, and on that last day. Now, that, for people who are going long options, it works against them because that brings down the value of their option. But people who are short options, it works in their favor because now they've sold an option and they take the premium in as cash, goes right into their account, and their ability to hold on to that will be completely dependent upon it decaying and then going into their account. Of course, they want to also be able to pick the price correctly so that they can keep all that premium too and not let the price of the underlying work against them. And that's what we do. We use this incredible advantage, this really edge in the, you may have noticed this, had hand surgery the other day. Hopefully this will be off in a few days. We take advantage of the 0 DTE event and we trade the E-mini S&P futures contract, and it expires every Monday, Wednesday, and Friday, and we put on a trade, typically put it on the night before, sometimes in the morning, and try to hold it as long as we can or as long as it makes sense to, and try to collect as much of that premium as possible. And we put on trades that put that whole event, that whole edge in our favor. And we do something extra. We do something extra that, as far as I'm aware, nobody else is employing this methodology. I use kind of a sort of the convexity principle that was developed, the anti-fragile principle that was developed by or explained by Nassim Taleb, and also use volume profile in determining the market structure. And then from that market structure, we're able to put on a trade that has a very high probability of success. Now, the other thing that we do that's very different than everybody else is that we don't put on, let me just say that we don't put on very high probability trades, or what most people think of high probability trades, which is normally an iron condor or something with really wide wings and then they take a tiny little bit of profit. No, we do something very different. And we are more or less trying to determine the directionality of the market, the momentum. And Wayne Gretzky would say, we don't go where the puck is, we go where it's going to be. And so we trade that way. And because of doing that, our trades have a very small amount of risk. And we can adjust it such that our risk is typically 1/3 to 1/5 to 1/15 of the potential profit. And so that's what we do. And in fact, this week was very exemplary of that strategy. We had 3 opportunities to trade the 0DTE this week, and we nailed all 3 of them. On Monday, we had a trade that was probably in the area of about 250 to 300% return on our risk. And on Wednesday, again, probably something in that area. And today was a special day, by the way. Today, if you were playing the 0DTE, it didn't expire at the end of the day. Most 0DTE options on the futures are PM expiring. But today, because it was the end of the quarter, it expired in the morning at 9:30 Eastern Time. So we put on a trade last night, and we took it off before the market opened at 9:30. And today you had the opportunity, had you stayed with the trade and the way we placed it, and you kept that trade on, you would have made over 1,000% return. Now you're hearing these, Ernie, how do you make 250%, 350%, 1,000% return on a 0DTE trade when most other people are shooting for a 5% or a 10% or a 15% return? How do you do that? That is part of our secret sauce. That is part of what we call the inversion of risk. That's how we trade, which is entirely different than what everybody else is doing in the 0DTE world. Now, if you're interested in trading like this, now just think about it. This week, we averaged probably about 350, 400% return on our risk. So in other words, if we put up $100, we bring back 400. All right? Now, most other people that are using 0DTE are putting high probability trades, which means they're going for a tiny little bit of premium. And if the price happens to move left or right and challenges those wings, they have a huge amount of risk there. So big that it can literally wipe out a month or 2 months worth of their trading effort. With us, it's exactly the opposite. We never take on that kind of risk. And virtually every trade is set up in such a way that it has the potential to make 250, 400, 1,000%, even 1,500% return. Now, which way would you rather trade? Now, here's the interesting part. The secret sauce, the way we analyze the markets using volume profile and my analytical method, I'm able to put these trades on what some people might consider a low probability trade and make them profitable, I would say better than 85% of the time. We've got a pretty good record going now over the past couple of months. We've had really maybe 2 losers. One of them was a very tiny little loser, under $100, and the other one was a little bit bigger because I traded something that I really didn't want to trade, but I did. And I won't be trading it again, and that's the SPX, the index. A lot of people are doing the 0DTE with the index, the SPX. And I'll tell you, it is the absolute worst way. Now, I know that I'm going to be ruffling a few feathers here, but trading the SPX is absolutely the worst way to trade 0DTE. And then some people will say, but Ernie, the commissions are so high on the futures. And that is a problem. If you trade and you're trying to get just a tiny little bit of premium, then the amount of commissions versus the premium that you put out there is a big chunk. Sure, when you're going for a 5 or a 10 or a 15% on your risk winner. But when you're going for 150, 300, 400, 1,000%, that commission and that fee structure is very small. So those people that have that issue with the futures, there is no such issue with the way we trade it. Now, the reason why I don't trade the SPX, there's a bunch of reasons. Really, the only thing the SPX has going for it is that it's cash settled at the end of the day. There's no chance of assignment. But even that isn't really a real issue because, quite frankly, we get out before we get all the way to expiration unless we know that our position is going to be out of the money and that we're not going to risk any kind of assignment. But that aside, that's really the only advantage that the SPX has, and that is that everything else goes against it. For one, it's only traded during market hours. When else do you trade, Ernie? With the futures, if you know about the futures, we can trade 23 hours a day. That means that I can take a trade at any time. And typically we start this when the futures session begins, which is 6 o'clock the previous day, 6 o'clock at night the previous day. And so that gives me all that time to collect more premium. Now, with the SPX, you have to start at 9:30 when the market opens. And so you've already got a bunch of premium decay in there, and so you're left with what you have. Now, for some people, that might not make a bit of difference. But having that flexibility to be able to put it on when I want, and sometimes even get out of the trade before the market even opens, before that volatility occurs, before certain events happen, is a huge advantage. Plus, when you're doing analysis of the futures compared to the SPX, there's no comparison. Every day there's a big gap of time gone on the SPX. There's no market between 4 o'clock the previous day and 9:30 that day, where with the futures it's continuous. And so I can analyze all that, and I can do a much better job, especially with a day trade. You would think that if you're going to be doing a day trade and you had the ability to be able to see all of the market activity right up to that point, you think that there's not much going on at night. There's a lot going on at night. You got the Asian market opening up around 9. You have the European market opening up around 3 a.m. There are economic reports that are usually coming out at 7 or 8:30 or 9. All of those things are impactful. And by having that extra capability of being able to analyze the market through those events, it's a huge advantage over the SPX. But that's not the half of it. The biggest thing, in my view, is that there is no volume that comes with the SPX. There is no volume because it's not a real thing. It's just a calculated index. There are no traders actually trading the actual SPX. Where futures, it's very different. You have volume. And so what does that mean? I can use volume profile. I can analyze the market. I have a distinct advantage where I can tell where or what the market structure is, where support and resistance levels are, where areas of value are and where they're not. And that makes all the difference in the world. So I can trade it around the clock. I get the advantage of continuity. I have volume. And quite frankly, I can get more premium and bigger profit. And because I choose the inversion of risk, I multiply all that by an order of magnitude or more. There is no contest. End of story. Trading the SPX sucks. Trading the futures is the only way to go when you're trading 0 DTE. Period. End of story. Don't even want to argue when I know I'm right. That's a quote from my mentor. That's what he always used to say. I don't fucking want to hear your opinion when I know I'm right. How much money do you need to get started? Asked Sergey. Most futures accounts require you to have about $2,000 in your account. I know that's the case with TD Ameritrade. I think that's also the case with Tastyworks and Charles Schwab. I think Interactive Broker, I think they require you to have $10,000. But I wouldn't use their platform anyways. I hate their platform, especially with someone with a little bit of ADD. Their platform is just a nightmare. I'm sure you like it, but if you're an international user, that might be your only choice. And they require a little bit more money. So it really comes down to that. How much money do you need to actually trade? We never really take more than $100 to $200 of risk, so you're never really putting up much more risk than that for each event, for the opportunity to make 100 to 200 to 1,000% of that risk. So in other words, you put up 100. This morning is a very good example. This morning we put on a trade that cost $112.50. That was the risk that we put up, plus commission and fees would bring that up to about, say $117 or so. That was our total risk, total out-of-pocket risk. And had you held right to expiration, you would have brought over $1,100. All right? So literally about a 1,000% return. All right? So you don't need a lot of money to make a lot of money in this game. You don't have to risk a lot. And more importantly, you're not sitting there biting your nails hoping that price isn't moving to the wings and jeopardizing your trade. We never feel that way. We put $100 on. If it doesn't go our way, no problem. We just forget about it. That doesn't happen very often. Like I said, 2 trades out of the past, 2.5 months, maybe 3 months that went sour. One of them we lost $100, and then the other one was with the SPX where we actually lost close to $500, only because of the size of the SPX. It forces you to go into a bigger trade. Yeah, that's another reason why I won't trade that again. The margin requirements in the SPX are just much, much heavier than they are with the E-mini options. So that's the way we roll. This week was, I think there were a lot of challenges. We hit all-time highs, but at the same time, it looked like the market was really struggling. And of course, we had all this talk of interest rates and volatility and inflation and all this other stuff. We had the Fed that weighed in, and it was really a tough week. We hit all-time highs, but it just couldn't get going. And so we pulled back, and right at the very last moment today, it pulled back hard. And, of course, we nailed that call. We absolutely nailed it and did very well. Of course, gold, there is a perplexing thing. Of course, why is gold going down when inflation is finally being acknowledged by the Fed that inflation's a problem? Of course, I guess it's the way they acknowledge it. They use, right now the Fed really has they don't have any more tools in their chest to be able to fight the coming or the impending doom that I see coming in the market. It's building up, the bubble, the inflation. The inflation really is a dollar problem. They've pumped so much money into this market that inflation is it's rearing its ugly head. Of course, I guess it all depends on how you count it. And so why is gold pulling back? Well, I guess the Fed is saying something that's propping up the dollar. The dollar had come down hard for a long time, and it was moving down hard. And so now for the last almost this whole week, it has bounced and gone up. But I want to tell you, if you take a good look at the dollar, it looks like it's setting up for what appears to be this massive head and shoulders. Now, a lot of people think that a head and shoulders is I guess what you would call a reversal pattern. But in fact, it's more often than not a continuation pattern. So I see this massive head and shoulders forming right at the bottom of where the dollar has landed. And it looks like once this right shoulder completes, it looks like the dollar is going by, in my view. And in that case, then we can see markets will respond to that. Commodities, which have been just totally devastated over this past week from this move of the dollar up, they're really pulled back. All the metals have pulled back, but I see them going higher in the future too. Now, the question is, will stocks also follow suit? Will the dollar dropping and then all this other impending doom, the credit crisis, the housing market, the inflation, are we going to enter a period of stagflation? I think that's really what's on everybody's mind. Of course, the Fed is telling us that inflation is transitory and we don't have to worry about it. However, every single measure that you use to look at inflation is telling us that it's here to stay. So they're using their war of words, putting the right apostrophe here and comma and dot here and the right and trying to convince us that nothing's really happening here. They have it all under control. But let me ask you, have you ever known the Fed to have anything under control? It's all just smoke and mirrors as far as I can tell. But that doesn't hurt us. It doesn't hurt us at all in the zero DTE world. and certainly doesn't hurt us in our other services. Okay, we get some more questions. Why do such small trades if you win so often? What does that mean? Why do such small trades? Because that's the size of the trade. That's one contract. That's a one minimal position size. You can scale that if you want. You could do 100 contracts and make it 100 times bigger. Come on, are you a trader? I mean, what kind of question is that? Yeah, it is per contract. What type of option do you use for a zero-date trade? These are options, Grant, on futures, on the E-mini S&P future. Alex is asking, hey, Ernie, from your description and risk profile, it sounds like you set up directional butterflies. That is actually absolutely correct. We do. We use butterflies. We put them into where we think the puck is going. All right. And I didn't mean to be harsh on you, Quant Kill, but that's just my nature. My mouth just goes on. Yeah, we are definitely using butterflies. Today we used a broken wing butterfly. We adjust the risk on each side to favor us so that today on the far side of our risk, and sometimes we put on super wide butterflies, sometimes very narrow, all depending upon what's the expected move, the volatility, the target zone, the market profile structure, the market structure. All of that goes into us optimizing where we're going to put this butterfly, where we're going to put it in the path of, and adjusting each side of the wing to give us the optimal equation. Most times we're putting on symmetrical butterflies and we can get really good risk, but today we put on a slightly asymmetrical butterfly, or what they call a broken wing butterfly, and that worked very well for us. And I think most people got at least a 400% return. I took off one trade for 450% and another trade for 750%. And some people may have held it into expiration. If they did, they would have achieved as much as 1,100% return today. So anyways, that's what we do. Now, we have a trial if you'd like to try this out. And I'm only going to be doing this, the type of trial that I'm doing now, for the next month. After that, I am switching up the trial. I'm going to shorten it up. Right now, the trial is for 4 weeks. You pay a little bit of money each week, and then at the end of that trial, if you want to stick with the service, I'm not sure why you wouldn't, because we hardly ever lose and we make a shitload of money, then I will refund that 4 weeks of trial that you spent towards your service. And the service is extremely reasonable, very well priced. And it's fantastic. The service overall is just a fantastic environment, first-class support. You actually get my personal mobile number. And we have a live Discord room. It's a private, secure room. A great bunch of people in there that are always willing to help. Whether you're brand new to options and futures trading or you're an experienced pro, I think you're going to find value in this room. Oh, I know you're going to find value in this room because we have all of the above. We have people that have been trading for 40 years, and we have people that are brand new. They all get equal treatment and first-class treatment, world-class support. Look, I've been in this business for a long time, going on 40 years, over 40 years. So I know what it means to treat people right. I know what it means to come in, especially when you're new and maybe a little anxious. That's the other great thing about this trading. We have, I think, and what I've developed is what I would call the zero anxiety trade. We're never feeling anxious because we have a great win rate, our risk is super small, and our potential profit is very large. And our win rate is very high. It's all the best of all worlds. What's the service price? The trial is $20 a week for 4 weeks. And then after 4 weeks, you can end the trial at any time. You can end it 1 week, 2 weeks, whatever. Wherever you end that at and you decide to take on the service, then I'll refund all that money to you. And the service is a $250 upfront fee and then $64 a month. Really a fantastic deal. If you go through the 4 weeks and then take it on, it's like getting the first month and plus getting a little bit of discount on that $250. The $250 really covers the support that I provide. And then the $64 is for the alerts. And that's how we do it. The idea, obviously, is that you pay the $250. That's good for a whole year, and you'll stick with the alerts for as long as you want to get them. But I think that you'll stick around. You'll like my analysis. As a matter of fact, to quote one of our members, my analysis is freakishly good. Kevin, today is my third day with Ernie. Kevin made 600%. Not bad. How's the hand doing? Super bloated, as you can see. They cut the whole thing open. Hopefully, I'll be able to take this off in a few days, and then it shouldn't be much more than a couple of weeks to get back to normal. All right. As I said, I'm going to be launching a podcast, not this weekend, but next week. And all the episodes here will appear on the podcast. So if you miss this show during the week, you can always take it with you on your phone or whatever and listen to it later. And it's going to be called 0 Days to Expiration. So it's actually that's the website that it's at 0daystoexpiration.com. Of course, for the service, it's 0-DTE.com. Don't go to the 0DTE.com. Their service totally blows. I shouldn't say that. They're nice people over there, and they have an okay service, but they're losers. 0-DTE.com. And look, you can be mad at me for saying that. I don't care. I can prove it, and I can prove that our service is literally an order of magnitude better. Or actually, I would say infinitely better, because I'm not even sure that they make any money, to tell you the truth. Anyways, there are other services that are out there that are all basically using the same methodology as the service that I was alluding to. There is one other service that is doing something similar to me, and that's with Scott Stewart. And however, I think that he overtrades, and he's not really doing the same kind of methodology or analysis. However, he is using butterflies. He's not using them the way we do at all, not even close. And he also has to use tremendous amounts of capital to produce his profits. Look, I've seen all the services out there, and people that have used my services have said the same thing. Look, I've seen all the services. There's nothing like this. All right. That's all I've got to say. One-handed trading. It's one-handed typing for sure. Excellent. All right, everybody. Thank you very much for taking the time to come to the show. Really appreciate it. Check out the trial. You've really got nothing to lose. Most people are going to take that trial and then make enough money to pay for the service for the next couple of years. Seriously. It's a no-brainer. And thank you. Of course, look, nothing is a guarantee. I can't guarantee that you're going to win. And in fact, the hardest part for most people that join my service is divorcing themselves from all the bad habits and anxiety-ridden trading that they have experienced in the past. And then getting down to this new way of trading, this totally anxiety-free way of trading. And it's been a transition for several people. And they've told me that they've gotten out of trades too early, only to watch them run on into hundreds of % return. And they get out after they've made their first $100, and they're watching everybody else making $200, $300, $400, $500 on their risk. And it's all because of the intense negative conditioning that they've had and bad experiences they've had with other services and how they originally were taught to trade. So this is a new thing. This is a new way, and it's a great way. And I think that you'll love it. Join it. I can virtually guarantee that you're going to love it. I don't know what that guarantee means. But anyways, the link is down below. Thank you very much for showing up here. It's time to go. Lots to do. And please give this video a share it with your friends. That would help me out a great deal. And hopefully we'll see you in our trade room. All right? Where's that off button? There it is. Take care.